Before we get into today's topic, if you are new here, welcome. This channel is updated every single day with the latest news, changes, and tips for Canadian pensioners. We have covered everything in simple language, no jargon, just the information you actually need. Hit subscribe and turn on notifications so you never miss an update that could affect your pension or your pocket. Now, let's get into today's video. If you are married or in a long-term relationship and one of you earns significantly more than the other in retirement, there is a completely legal way to move up to half of that income onto your spouse's tax return and potentially save your household thousands of dollars every single year. Most Canadian couples have never heard of it. Many who have heard of it assume it does not apply to them. And a surprising number who do qualify simply forget to file the one form that makes it happen. Today, I am going to walk you through exactly how pension income splitting works, who it helps the most, and what you need to do before the April 30th deadline to make sure you are not leaving money behind. And I will come back to something a little later that I want you to keep in mind. There is one specific situation where income splitting does not just save a couple of few $100s. It saves them their entire OAS pension. I will explain exactly what I mean by that in a few minutes. Stay with me. Welcome. My name is Naim, and today we are talking about one of the most powerful and most underused tax strategies available to Canadian couples in retirement: pension income splitting. This is a legal tool built right into the Canadian tax system that allows you and your spouse to share certain types of retirement income for tax purposes. When one partner is in a higher tax bracket than the other, which is very common in retirement, this strategy can reduce your combined tax bill significantly. We are going to look at how it works, who qualifies, what income can and cannot be split, and the practical steps you need to take to actually use it. Let us get started. Let us begin with the basic idea, because once you understand the core concept, everything else makes sense easily. In Canada, income tax is calculated individually. Each person files their own return and pays taxes based on their own total income. The more you earn, the higher your tax rate. And in retirement, it is extremely common for one spouse to have significantly more retirement income than the other. Maybe one partner had a longer career. Maybe one has a larger pension or a bigger RRIF. Whatever the reason, when one spouse earns much more than the other, the household ends up paying more tax overall than they would if the income were distributed more evenly between them. Pension income splitting solves this problem. It allows the higher earning spouse to allocate up to 50% of their eligible pension income to the lower earning spouse. Purely on paper, for tax purposes, the money does not actually move between bank accounts. You do not need to set up transfers or change how your payments arrive. It is simply a declaration on your tax returns that says, for the purposes of calculating our taxes this year, we are choosing to treat this portion of income as belonging to my spouse. The result is that the higher earner reports less taxable income. They drop into a lower tax bracket. The lower earner reports a bit more, but since they are already in a low bracket, the tax on that additional amount is minimal. The household pays less overall, sometimes significantly less. Does your household have one partner with meaningfully more retirement income than the other? If so, keep watching, because this strategy was designed exactly for your situation. Now, here is where a lot of people get confused, so I want to spend a moment on this carefully. Not all retirement income qualifies for splitting, and the rules change depending on your age. This is one of the most common mistakes. People assume they can split anything, and then they discover the restrictions after the fact. If you are 65 or older, the list of income you can split is quite broad. Withdrawals from a RRIF, a registered retirement income fund, qualify. Payments from a company or employer pension plan qualify. Annuity income from registered savings plans qualifies. Even certain foreign pension income can qualify, including United States Social Security payments if you receive those. If you are under 65, the rules are much more limited. In most cases, only direct payments from a registered employer pension, meaning a workplace pension plan, not an RRSP or RRF, qualify for splitting before you turn 65. So if you are in your early 60s and you retired early, your options may be more restricted until you reach 65. And now for the most important exclusion: the one that trips up the most people. Your CPP, your OAS, and your GIS cannot be split using this method. I know that surprises a lot of people. These are the three biggest government pension payments, and yet none of them can be allocated to a spouse through pension income splitting. CPP has its own separate sharing arrangement, and we have covered that in another video, but that is a different process entirely. What we are talking about today applies to private pension income, RRIF withdrawals, and annuity payments, not CPP, OAS, or GIS. So before you assume this strategy applies to you, it is worth taking a quick inventory. Do you or your spouse receive income from a RRIF, a company pension, or an annuity? If yes, this is absolutely worth exploring. Now let me show you two of the most powerful ways this strategy can help a retired couple in real life. The first is something called doubling the pension income credit. In our recent video on overlooked tax credits, we talked about the pension income amount, the credit that gives you back $300 in federal taxes on the first $2,000 of eligible pension income. Each person can claim this credit, but here is the catch. You can only claim it if you are actually reporting eligible pension income on your return. So imagine a situation where one spouse has a large RRIF and reports all of it on their return. The other spouse has no pension income at all. The couple captures one $300 credit. That is it. But if the higher earning spouse splits just $2,000 of that RF income onto the other spouse's return, suddenly the second spouse also reports eligible pension income. And they also claim the $300 credit. The household now gets $600 instead of $300, doubled, for doing absolutely nothing except filling in one form. That is $300 in savings that most couples simply leave behind every year. And if this sounds familiar from our tax credits video, it should. We mentioned this exact move as a strategy for capturing the pension income credit for free. Today, we are showing you the mechanism that makes it possible. Now, here's the second benefit of income splitting. And this is the one I flagged at the beginning of this video, the one that can save not just a few $100s, but an entire OAS pension. Your OAS, your old age security payment, is subject to a clawback. If your personal net income goes above a certain threshold, the government starts reducing your OAS by 15 cents for every dollar above that line. In 2026, that threshold is just under $96,000. If your income gets high enough, your OAS can be reduced to zero, completely clawed back. Now, a lot of people assume this only affects wealthy retirees. But think about what happens to someone at age 72. They are receiving CPP. They are receiving OAS, and now their RRIF mandatory withdrawal kicks in, which can be $50,000 or more per year for someone with a large account. Add those numbers together, and it is not hard to get close to or over that threshold without having what most people would consider a high income. Here is where pension income splitting becomes genuinely powerful. If the RRIF income is entirely on one spouse's return, pushing them above the OAS threshold, up to 50% of that RRIF income can be shifted to the other spouse's return instead. Suddenly, the high-earning spouse's income drops back below the threshold. Their full OAS is protected, and the lower-earning spouse absorbs the extra income at a much lower tax rate than the higher earner would have paid. Let me make this concrete. Imagine a couple, Robert and Ann. Robert has a large RRIF. Between his CPP, his OAS, and his mandatory RRIF withdrawal, his income adds up to about $140,000 for the year. Without income splitting, he loses a significant portion of his OAS to the clawback, and meanwhile earns about $30,000. Together they split 50% of Robert's RRIF income onto Ann's return. Now Robert's income drops to roughly $85,000, safely below the threshold. His full OAS is protected. Ann's income goes up, but since she was in a low bracket to begin with, the extra tax she pays is modest. The household comes out far ahead. In some scenarios, a couple in this situation can save $8,000 or more in a single year just by making this election. That is not a small amount. That is real money that belongs to your household, and it disappears permanently every year you do not claim it. Now, let us talk about how you actually do this, because the mechanics are simple. and I want you to walk away knowing exactly what needs to happen. Pension income splitting is done through a form called the T1032. It is called the joint election to split pension income. Both spouses sign it, both file it with their individual tax returns. On it, you indicate how much eligible income is being transferred and up to 50% of the qualifying amount, and it flows through to each spouse's return accordingly. There is no complicated paperwork. No need to contact Service Canada or your pension provider. The money keeps arriving exactly as it always has. The only thing that changes is how each of you reports it to the Canada Revenue Agency on your annual return. Here is what I want you to remember. This is an annual election. You make it fresh every single year. That means if your situation changes, if your income shifts, or if your spouse's income changes, you can adjust the split each year to get the best result. In a year where splitting 50% makes sense, you split 50%. In a year where splitting 10% is better, you do that. You are not locked into any fixed arrangement from one year to the next. And because this is done through your tax return, the April 30th filing deadline matters. That is the date by which both returns and the T1032 form need to be filed. Missing the deadline does not just mean paying your taxes late. It means this election does not happen for that year. And unlike some other adjustments that can be made retroactively, optimizing the exact split amount is best handled in the original filing. This is yet another reason why that April 30th date is so critical for Canadian seniors. Let us also touch on one practical detail that confuses some people. When your pension or RRIF provider withholds tax at the source, meaning they take a portion of your payment before it even reaches your bank account, that withholding follows the income wherever it goes on the split. If you transfer 30% of your RRIF income to your spouse's return, a proportional share of the tax already withheld is also credited to your spouse. Your spouse does not suddenly face a large unexpected tax bill from the extra income they are now reporting. The credits follow the split. It balances out properly. This is one of the reasons income splitting is so clean and straightforward compared to other strategies. There are no unpleasant surprises if it is done correctly. The tax withheld at the source, the credits, and the income all flow together in the same proportion. Let us bring everything together. Pension income splitting is one of the most effective, most legitimate, and most underused tax strategies available to Canadian couples in retirement. It works by allowing the higher-earning spouse to allocate up to 50% of their eligible pension income, RRIF withdrawals, annuity payments, company pension income, onto their lower-earning spouse's tax return. No money changes hands. One form gets filed, and the household benefits. It can reduce your combined tax bill by keeping both partners in lower brackets. It can double your pension income credit from $300 to $600. And for couples where one partner has significant retirement income, it can prevent the OAS clawback from taking thousands of dollars that you have every right to keep. The form is the T1032. Both spouses sign it. It goes with your annual tax returns, filed every year by April 30th. The split can be adjusted each year based on your circumstances. If you and your spouse are in retirement and one of you has meaningfully more income than the other, please bring this up with whoever helps you file. If you file your own taxes, look for the T1032. It is one of the simplest tools in the tax system, and the savings it delivers can be significant over the course of a retirement. You worked hard to build this income. This strategy helps make sure you keep as much of it as possible. If this video opened your eyes to something you have not been doing on your tax return, please share it with another couple you know who might be in the same situation. A brief conversation today could save someone real money this year. And if you are not subscribed yet, please do. We post new videos every single day covering Canadian pension updates, benefit changes, tax tips, and practical financial guidance for seniors, all in plain, simple language. Tap subscribe and turn on the notification bell so you never miss an update that could affect your retirement income. Thank you so much for watching. Take good care of yourself, and I will see you tomorrow.